Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
This show is brought to you by Miles Franklin. They've been selling gold and silver for 22 years, and I'm a customer because when you buy, they ship. For more information, go to milesfranklin.com or call them at 800-822-8080. 1490 WGCH. This is Carrie Lutz, and you're listening to the Financial Survival Network. If you're wondering if you're in a recession or a depression, you need to hear from Bob Hoye. He studied virtually every economic boom and bust in history and has a very informed opinion on the subject. Contrarian, you'll be very surprised by what he has to say. Hey, Bob, welcome to the Financial Survival Network. We're really happy to have you on.
Good to be with you, Kerry.
Taken a while to get you, but we got you. And my first question is, are we in a global depression right now?
Yeah, I like to use the term post-bubble contraction. It doesn't sound as severe, but it gets the operation of it, because essentially where the bubble period, and let's face it, there were serial bubbles going on since the 70s, and you finally got the culminating one in 2007, 2008, that then had all of the characteristics of the great financial bubbles since 1720 South Sea bubble, and that makes the 2007 peak and change in the credit markets number 6. So you have a lot of evidence here. So the mania is an expansion of credit, and then the post-bubble, post-mania period is a contraction of that credit, where people in the boom willingly take on debt because it seemed to be able to really make money on leverage. And then the rest of the period they're trying to get off it because the prices are adverse. So we can say that although the volatility is really wild from time to time, there's enough evidence to say that we are really in a post-bubble contraction. We could call it a Great Depression, and that the crash ended, and the percent decline in the S&P, for example, was similar to the 1929 crash. It just that it was protracted over from October 2007 right out to March 2009. It was a longer, but the price decline was the same. And then once the excesses had been washed out there, then you had the first bull market out of the crash and the first business expansion. And our work recently expected out of October that we would recover out into the first quarter. And this is it looks like we're getting a rolling top here in the stock market. Base metal prices are in a short-term downtrend. So there's enough signs around to say that the economy is very toppy and the stock market became toppy. So that gets us to the next point, is that a recession is highly likely. And that then would mark the discovery by many people that all of the huge hands-on stimulus really didn't change things too much. You still have the 3 to 4 year business cycle to contend with. And this time they've added how much debt, how bad stuff is the Fed carrying? Well, we don't know.
Who knows?
So perhaps maybe by September there could be enough evidence with a weaker stock market and weaker base metal prices to say that, yes, the next recession has started. And one of the other things we look at, Kerry, is that the behavior of the credit markets, and they've been pretty positive coming out of October. And we found, credit spreads narrowing, and that's the difference between high-grade bonds and low-grade bonds, and people reaching for yield. So there's a lot of confidence there, and it has narrowed spreads noticeably. And oftentimes when you get good action in the spread market going in the last into April, well, there's usually a seasonal change into reversal from credit spread narrowing to credit spread widening. And if the party's been pretty good in the first part of the year, you can pretty well be assured that there will be distress in the credit markets going into the fall. And it's the old, sell in May and go away thing. But that is, I think, based upon what happens in the credit markets. So the next 6-7 weeks will be very interesting. Some instruments are beginning to change. Mortgage bonds, MUB, you've got in a downtrend now, just testing the high in February. The dreadful subprime mortgage bonds, they had a good rally coming out of October, made their high in February, and 2 weeks ago broke down in price. And various other items. There's been not much widening in money market stuff, like less than 1 year. You got the TED spread. Let's put it this way: it's no longer favorable. It's spread's not narrowing, but then it's not widening either. But at the long end, there's enough widening going on to support our view that they were close to seeing the start of the next recession.
Yeah, you're probably spot on there. I wouldn't doubt it because it all seems to be an illusion. But here's the next question that's kind of linked to all this. Are the stories of the death of the U.S. dollar greatly exaggerated?
Yeah, it's one of those things where if there were no interventionist economists and central bankers, there'd be no gold bugs, because there'd be no currency depreciation as a policy. But we work a little differently on that, because there was long periods in history when the senior economy, then Great Britain, was on a gold standard. So there was no apparent change in the price of gold relative to currency. But what happens is you just take the annual price of gold and the consumer price index, when it's reliable, it shows that gold records a very significant low in the year that a bubble blows out, whether it was 1929 or 1873, doesn't matter. And then you have that's the start of a long recovery in gold's real price. And this is important because in a boom, when you got prices of housing going up or stocks or commodities or even bonds, well, money, the value of money going down, and gold is money, so the value of gold goes down in a bubble. And it has done, because we gave up on the U.S. Consumer Price Index years ago and took for a quick read on the gold's real price, we just took the price of gold and divided it by our own commodity index, which we hoped would act close to the Economist, all items. And it's fairly close. So that worked out, because on that index, gold fell to 134 in May of 2007, and then it started to go up as the credit markets turned to go down. And as we said at the time, that's the way financial history works. And then on the crash down to March of 2009, that gold divided by commodities index got up to a little over 500. And it's interesting, Kerry, that when we discovered that when this index changes, it leads. For example, in the crash bottom, the real price of gold started to go up 2 weeks before the panic ended on March the 9th, 2009. And then more recently, it started to go up, and that's been leading the topping in the stock market. So it does provide a lead. So we from over 500, it got down to 300 in April 11, and then with the crash, the pressures of last October, it got up to about 490, and then we recently was sort of down to 420. And So it's trying to turn up here. So it will be doing two things. One, it shows an improvement of operating profits and margins for gold mining. And the other is that it's an indicator against the stock market's heading down. But throughout all of these booms and busts, the big bubbles, and the long periods of contraction, the real price of gold goes up. So what this does is make gold mining the premier industry because it makes money during a deflation. And we can show this more immediately with the history of homestake mining, which back in the late 20s and the 30s was the premier producer. The stock went up a bit with the 1929 bubble, and then it crashed with the crash. But you could have bought homestake stock for $9 for the first half of 1930. And if you go then to the end of 32, this was before Roosevelt started fooling around with the price of gold. So the price was fixed, as we all know, at $20.67 an ounce. But because of the boom in the late 20s, the real price went down, like cost of energy, cost of mining went up. So homestakes earnings diminished dramatically with the 1929 boom. And then with the bust and the deflation and all the horror stories there, the real price went up, but although the dollar price was still $20.67, by the end of 32, homestake stock was up about 130%, and the earnings were up 130%. So then in 1933 is when Roosevelt got this idea that if he raised the price of gold, it would raise farm prices. Didn't work. But at any rate, what he was doing was getting on board the bandwagon that the real price of gold goes up. So when he raised it to 35, that also worked out in real terms so that the real price continued up. And then homestake, went up into the 30s. But the interesting thing was that all through the 1930s, it went up 65 on that basis from $9. And through most of the 30s, it was paying $4.50 a share dividend.
Really? On
a $9 purchase. That's making a lot of money.
Wow, that's huge.
But it's as far as you can get statistics going back in time, there's evidence that each Great Depression was a great time for gold mining. So this is why we're very, very bullish on gold stocks over, the next, 15 years or so. Anyways, it'll be interrupted by a business cycle, of course. But more recently, last month, we've looked at things, and we looked at the price of gold, Huey, because it's got a long history. And my colleague also keeps it tracked and transposes it to homestake stock way back. So we've got this gold relative to gold stocks going back to the 1920s, and it became cheap. Then if you look at gold stocks relative to the S&P, that became cheap. And then more recently, like a couple of weeks ago, even if you use some of the RSI on those ratios, they became exceptionally cheap on momentum. So this is where we then are now very positive on gold stocks. And we even did the juniors relative to the seniors with the GDXJ divided by GDX, and the juniors are cheap. And we note that on the last big rally for gold stocks that the juniors did outperform on the way up, and sad to say they underperformed on the way down. As we know, it's been pretty dismal since October.
So what about metals prices and the stock prices? They appear to be greatly manipulated. I won't say fixed, but certainly rigged to some extent. Does that work in the long run?
No,
that manipulation.
No, I hate to say this, but it has some amusement that policymakers, when there's too much of a boom, they say that, it's an overshoot in policy. And same thing when the recession, it's an undershoot. You have the macroeconomists, they're out, is that, we have an exogenous event that that pushed our models off. Well, for example, the silver bug, when silver stops going up, and their forecasts don't work because let's face it, the work they do on supply demand is quite detailed. But anyways, it doesn't work, and the first thing they say is conspiracy. Mm-hmm. That the government or the central bankers or something do to rig gold down and silver, or particularly silver down. But we found that the relationship between gold and silver is very methodical, going through a boom-bust cycle, that when you've got a good market for gold and silver, bull market, silver always outperforms gold, and the gold-silver ratio goes down. And then as a matter of fact, it's one of our indicators, then when it's time for a bear market for gold and silver, then silver always underperforms gold, and the gold-silver ratio goes up. And for example, last year going into April, the fabulous market for gold and silver, and the gold-silver ratio, of course, was coming down, but the RSI got to a level that said, hey, that was unseen since 1980. So the momentum on it was sensational, and we've been suffering more or less since. But I think there's enough things going on technically, as I said, with our ratios of gold stocks relative to gold, and gold stocks relative to the S&P, and gold stocks relative to each other, that the turn is being made. It may take 5 or 6 weeks before you really got a really good move out of it, but it's going to run for a few years, so that perhaps a year and a half from now, the gold stocks will be very much higher. But we should also keep in mind that they have a tendency to go up and down with the big market in New York. But at the same time, a year and a half from now, the S&P will be very much lower. So the swings, you're going to end up with gold stocks netting out good gains on each cycle as they go up and down. That's the wrong term to use, but intermediate moves.
Right.
So I like the industry.
Mm-hmm. So I guess the final question is, you hear people with these predictions, what the price of gold should be, what the price of silver should be. If you had to call it, and not pinning you down to an exact number, but is it in the multi-thousands? Is it over 10,000? How high can it go?
Well, that's using the idea that the U.S. dollar is going to go to zero in a disaster. But we should look back on the last 20 years or so, where the dollar going down has prompted huge speculation in base metal prices, grains, housing, and stocks, and even in bonds, corporate bonds. And of course we know that policymakers, their remedy for whatever is a weaker currency. So let's face it, the softer U.S. dollar has been the best thing that could happen to the financial markets if you want to get leveraged and making a lot of money in everything but gold. So what we're looking for here now is that, like going into the fall of 2008, everybody was pretty sure anybody with experience was pretty certain that you're going to have a tremendous wipeout going into the fall. But the gold community all thought, the disaster will be finally the U.S. dollar going to zero. It surprised them. U.S. dollar went up, and as did eventually the real price of gold. So with the example of Homestake in 1929, early 30s, it doesn't matter what the dollar price of gold does. It matters what the real price does and what the credit markets are doing and alternative investments. So using history as a guide, Kerry, there's very good build-up for a real rally for gold and improved earnings and operating margins. Even if the real price of gold goes up, and it's clear to understand when you look at crude oil, when crude oil is outperforming gold, and crude represents energy, and you use a lot of energy in operating a mine, certainly including blasting agents and all that sort of stuff. So you can't make money when the price of gold is not outperforming everything else. So this gets back to the real price. So if you can see the price of crude oil heading south, well, then it's a proxy for energy cost. If base metal mining is impacted by falling base metal prices, there'll be slowdown in that side. There'll be miners laid off. So then you have a lid on wages. So in looking at the history of all these things, really the best time for gold are in the post-bubble deflation, when the purchasing power of gold and money is going up and everything else is heading down. So this is why in each post-bubble depression, gold mining has become the premier industry. And it'll be interesting to see, I mean, the idea of central banks holding each other's paper as a reserve, of course, has always been absurd, but you're going to find some younger new wave economists are going to come along and come up with some theories about why central banks should be holding gold as a reserve. So I fully expect that to come along, and there'll be a fair amount of irony with that one, because they'll have to condemn all the old thinking and get off the idea that gold is a barbarous relic. Hell, central planning and central banking is a barbarous relic. So
that's my feeling. I'm with you there. So if people want to learn more about your work, Bob, where would they find you?
Oh, yeah, we've got the website institutionaladvisors.com. Or actually, I found this just a short while ago, that if you just Google my name, Bob, B-O-B, H-O-Y-E, it all comes up. I was quite surprised at that. So
it does. I could tell you that from personal experience. It all Google seems to be keeping track of all of us better than the U.S. government.
Yeah.
So, hey, it's great having you on, and we'll look forward to having you on the show again. And we're watching those miners and the price of the metals, because that's the canary in the gold mine, right?
I like that phrase, Gary. Good to be with you.
Hey, you too. You be well. Thanks again.
Yeah.